So ladies and gentlemen, join me in welcoming Angus Champion de Crespigny. Welcome.
Thank you. Thank you very much. Hello, everybody. Do I have it? There's the clicker. Hello, everybody. Thank you for having me and coming along and listening to, well, what I'm going to tell you about all of this. My name's Angus de Crespigny. I look after the blockchain strategy for financial services at Ernst & Young. What does that mean? For the last few years, we've looked at how this technology can change how financial services works. What are the opportunities? What is hype? What is not there? And it has been interesting, to say the least, to watch how the perceptions of the technology has changed within financial services, outside people's views of how this can change financial services. So what I want to do today is a few things. One, address a few myths about the technology, about Bitcoin and cryptocurrencies and financial services generally. I'll then talk to what financial services institutions have been doing and how they perceive the technology, and finally, what they're working on and where likely this is going to be evolving. And I think it's a lot more collaborative than people possibly expect it will be. So, firstly, from the scope of financial services, there are things that Bitcoin and blockchain technology is not. It's not faster and cheaper payments. It is if you ignore all compliance requirements, all operational requirements of fraud requirements of a fully comprehensive payment solution. But financial services could do the same if they ignored that. So, the technology problem, the problem with payments in financial services is not the back-end technology. There are a number of other things at play. Fraud reduction technology. The reason we have fraud protections, chargebacks, all of that sort of thing is for consumer protections, for merchants that may be malicious, not delivering. This simply flips the blame, right? It flips the onus, right? Now the fraud exposure is to the consumer who's sending the Bitcoin. Back office infrastructure replacement. This has been one thing that's been touted in financial services, that we can reduce clearing and settlement and we can streamline everything by gutting our back office and putting in a blockchain. We've yet to see that being useful. So, therefore, what can it be? Firstly, an enabler for more convenient payments. What are payments that we haven't been able to do to this point, but we will be able to do? Think, machine-to-machine payments, software automated payments, those sorts of things. A global data anchor. This is relevant in financial services when we start looking at things like identity, when we start looking at possibly, audit records or supply chains. And finally, an enabler for new financial products. We're seeing this with ICOs, right? The token space, creating new tokens, creating new business models. Some of these tokens are straight equities. Some are utility tokens that have some value attached to it. We're early stages, but essentially what we're looking at here, the benefits are things that we couldn't do before. And this is something that financial services is starting to come around to, that for all of the hype, for all of the excitement, the new technologies thrive on new workloads, on new products. Email was not the killer application of the internet. It was things that we could not do before, connecting, communicating, the Snapchats and Facebooks of the world that really were just not able to do previously. And blockchain technology is the same. So, considering that, a few other myths about financial services that get sort of thrown around with cryptocurrencies. Regulators don't understand the technology. We speak with a lot of the regulators. We help them understand this. We help them determine what might be the risks, what might be the exposures. They determine what's the best sort of regulatory regime to work through that. And typically where it comes to is it's probably too early. The risks at the moment are small, considering other risks around financial services, around the economy. But very often, some of the top people in this space are regulators who have looked at this, because if they are to muck it up, that's their job on the line. They understand this space. Don't necessarily confuse lack of apparent action or lack of announcements with the lack of action. There's a lot of stuff going on in the background. The regulators get it. The regulators understand this is complex. And the regulators don't want to shut down something that could have, a lot of larger macro benefits. Secondly, banks are trying to destroy Bitcoin. This I hear a lot. Very simply, banks aren't trying to destroy Bitcoin because most of them don't really see it as a threat. Whether they should see it as a threat or not is another thing. But banks at the moment, it's a curious asset class that some of their clients are interested in, and they want to help their clients access that. And they feel that there's the technology that they may be able to improve some of their operations. Are they trying to destroy Bitcoin? Honestly, at the moment, how they see it, they've got bigger fish to fry. They've got bigger, revenues, bigger products that they can sell. And it's not something that they are, particularly concerned from that angle. Now, there are some that are looking at it and saying, look, we really need to understand this, because longer term, this could be a big disruptor. But do you have some big concerted effort from these organizations to try to shut it down? No, it's not really, it's not really how they're perceiving the technology at the moment. Bitcoins will destroy banks. So I put a question mark with this because, as they say, software is eating the world and we don't know what's going to happen in the future. But I kind of liken it to journalism and the internet, right? If you look at banks as only facilitating payments, as only allowing people to hold money and send money, then yeah, they're in a whole lot of trouble. But there's actually a whole lot of other stuff that banks do. And your deposit account, your checking account, your that initial payments thing, that's for them to get you on board and get credit and sell you credit cards. Mortgages, car loans, for bigger companies to manage their treasury operations, manage risk, build new derivatives, help them launch new businesses. So no two banks are the same. What is and this is why they all collaborate, because Bank of America will work with State Street on one particular thing and they'll compete on others. But State Street will be the top in the industry for X, Bank of America for Y, and they benefit from that synergy. So financial services is incredibly difficult to disrupt because of so many moving pieces, because of all of the regulatory work. But with the backbone being money moving around between it and how you manage it, changing how that operates, changing people's access to that, much like journalism and the internet, it hasn't killed newspapers, but it's opened up a whole new avenue of journalism that possibly wasn't really available before. But with all of this, what are the banks actually looking at? It can fall into four areas with varying levels of success. Securities, commodities, transfers, and payments were the first off the rank, right? Maybe payments because of Bitcoin and people, you have these brilliant engineers coming into bank boards and saying Bitcoin is going to, I can move value from A to B and it's going to get rid of, it's going to totally disintermediate you. Started having a look at that, and as I mentioned before, payments is difficult because it's a network business. So it's a network business, and it's a business that has a lot of regulations around it. So if we put aside the fees for a minute, which is always fun to watch the discussions of Bitcoin fees on Twitter. But if we put that aside, sending Bitcoins from here to Japan, yes, virtually instantaneous, virtually free for larger amounts. But I'm not including any compliance cost of who I'm dealing with. There's no ability for me to claw back money if it turns out I've dealt with a fraudulent party, if I've sent it to the wrong person. So you add on user interfaces onto all of that. The banks are doing that. There's operational costs around that, and it starts to kind of converge, and the costs sort of look the same. So payments is difficult. Securities and commodities transfers. Similarly, if payments don't work, then securities and commodities, they take 3 days. Can't we immediately create new assets, send them to people, and we don't need to wait for 3 days for it to all clear? Yeah, you could, in theory. The problem being that because of that 3 days delay, capital markets organizations have built businesses in that meantime to make money out of the time where someone is owed a security, you still have the security, and they can do interesting things like stock lending and that sort of stuff, and those start becoming profitable. They've become profitable businesses, but now there's actually not really any technical limitation in securities and commodities transfers that can mean you can't have that settlement instantaneously. And by the way, I'm grossly simplifying. For each of these here, there have been areas where clients have found that for their specific architecture, for their specific design, this happens to be a good thing, but so I'm talking sort of more generally. So then we get to these two, KYC and supply chains, and these are really sort of the only private, two of the kind of few private blockchain applications that are kind of universal. And the reason being is because sharing private information across many different parties is actually hard for a single organization to do. If I have an account with a bank in the UK and I move over to the US, then I need to open a brand new account. I need to show them all new documentation. They're legally unable to share that information across boundaries. We can create a blockchain within the bank to ensure the integrity of digital data that may be shared between those regions and drastically streamline that customer identification within a bank. Supply chains and trade finance, all you need to do for that is store very simple pieces of data along a supply chain that everyone can access. It doesn't get too complex. You don't need massive consortiums designing very complex processes for it. It's just very simple time-stamping documents into all of that. The thing is with all of this, though, don't know if you guys can see that, but the main technology problem that banks and financial institutions face is from technology integrations. They are massive institutions, massive organizations. They're conglomerates, right? They, you don't have banking services. You have credit cards, loans, mortgages, payments, risk management. Anything in the financial services space, it's been collapsed under, all these various conglomerates with massive data centers, with different systems that all plug into each other. And in short, there's not a bank that doesn't have some sort of data quality issues because of all of this. A blockchain doesn't really fix that. A lot of banks could benefit from a giant global multinational data warehouse that stores all of their data consolidated. But that will have a payoff of decades, huge costs, and they just haven't done it. So why would they do it with blockchain? And which goes to the second point that, yeah, sure, you could use a blockchain with this. But could it also be done with an append-only database? And if it could, why hasn't it been done to this point? And that's usually the former piece. So with all of that, it starts to look less exciting than it did initially as a financial institution, and you're looking at this big technology that's apparently going to drop your fees or costs by 20%, or pull out the arbitrary number that someone's come out and pitched, right? So where are we seeing some, but that's not to say that there aren't opportunities here, and organizations aren't building some some pretty impressive systems around this. The interesting point, though, is really this. And this has moved incredibly quickly. And I felt this was going to, I feel anyone in crypto knew this was going to happen, but it's happened much faster. Due to the last 6 months, where people have done generally pretty well out of their crypto balances if they happen to be hodling for the last few years. This giant jump it's hit newspapers. It has been reported in the press. You get, the 18-year-old student who took, 300 Bitcoin or something instead of a $100,000 scholarship, and, now he's a millionaire. And you get more and more of these stories, and you get hedge funds and asset managers and high net worth individuals saying, hey, I kind of want to get in on this. Now, when high net worth individuals or, a big institution wants to now start getting into cryptocurrencies, they call their asset manager, or they call their capital markets, broker dealer, and they say, hey, can I, how do I get in on this market? And then they start building this into their systems. So it's, there's a big difference between the bank's money and the bank's client's money. The banks want to, like anyone in business, want to help their clients, want to provide their clients what their clients want. And clients now are starting to ask for cryptocurrencies. So we're starting to get more calls and starting to do more work in this space to help major asset managers look at this and help their clients bring in cryptocurrencies. So where does that kind of, where does that sort of leave us with all of this? If banks are providing this to their clients, they're not trying to shut it down. We're getting to a point where, as cryptocurrency is becoming legitimized as an asset class. And in the same way that people will buy stocks or buy an index fund or something like this, it starts being directly applicable or directly useful to individuals in this space. When you think of the big picture of regulators coming in and trying to shut this down because it seems to be getting out of hand, there's fundamental risks to the economy, all of the sort of stuff that we kind of feel that, that some people feel that regulators look at it, much like car sharing, when, in Austin, I think it was, banned Uber, people will be used to it. People are getting used to it, and people don't like regulators taking away things that they want, if there are enough people and voters that are, that want that. So where I'm going with this is that you've got, to go back a bit, so these here, possible opportunities, possible cost savings. This here, immediate need from your clients, immediate new revenue opportunities with simply bringing a new asset class in-house. This is going to increase, this is going to snowball a bit as one provider starts doing it. Others will keep on doing so. Regulators will look at it, see how they can assess it as an asset class, and it becomes mainstream. So it's, where does this? So with all of that, financial services are very complicated. So disrupting them is even more so. But there's also a lot that we can do within the bounds of financial services, particularly with cryptocurrencies and their adoption, where we can somewhat work with that, right? Blockchains don't need to do everything to be revolutionary. Even just Bitcoin or Zcash or Ethereum, or choose your favorite flavor. Creating an uncensorable value transfer mechanism or an uncensorable data anchor, that just simply by itself is hugely valuable. And finally, it's not a zero-sum game with this. There's a lot of animosity towards financial institutions. Some people ask me, so if I say all of this, Jamie Dimon stood up and said Bitcoin's a fraud, I typically answer saying that JP Morgan's a client, so I can't comment on that. But there's a difference between individual views of bankers and what they're going to be providing to their clients. And this has a habit of just simply, this has a habit of becoming legitimized simply through use. So, so we can all win with this. Cryptocurrencies are becoming legitimized. They're here to stay. And, financial institutions are looking on them legitimately now. So, so going forward, I imagine we're going to be seeing more of this, more Bitcoin on the front page of the Financial Times and the Wall Street Journal. We'll see more of it just being provided as simply a financial product that you can invest in. And as that becomes more embedded in our vernacular and day-to-day use, then as the technology evolves, I think we're going to see some very exciting things. So I will stop there. I think that's all of my slides, but open for any questions for kind of the next 10 minutes.
First off, good job.
Oh, thank you.
So you said that the financial services folks are bringing services in-house. They're offering it to high net worth individuals, asset managers, things like that. Do you see them running their own wallets? Do you see them trying to steer clients into particular currencies? Do you see them having their own and making that a part of, like leaking over into their private wealth management who is promoting it?
Yeah, so firstly, they will we'll probably see a mix, right? Them having their own wallets, but then also those that, managing your own wallet is quite a liability, right? So they will also work with custodians. That'll be some of the usual suspects in the startups in the space that have that infrastructure already set up, and they'll just simply provide the mechanism to go through, right? They will they push them into certain currencies? That'll be interesting to tell, just with like fiduciary responsibilities, how much they are going to be able to recommend with certain, other funds that they may have if they've got their own holdings. I think at the moment, generally, this is they don't have the in-house expertise to recommend particular currencies, but that will come, right? So I know, hedge funds have been in this, I think, for a while. They do have analysts, right, that are looking at this and can, see what the market's saying, and they can, recommend internally for their own prop trading where they should go. Downstream, I see no reason why banks won't have analysts that'll say, Zcash as, some interesting new thing or capability that therefore we see will be more, more adoption. I could see that in the future, but there's not the in-house knowledge yet to really be pushing anyone towards one commodity, one crypto or another.
So the 24/7-hour nature of cryptocurrency trading, it has like this compression time effect, right? Like it tends to speed up the market behavior. And to a certain degree, like, corrections and things like this, it has some effect. I'm wondering with the coming like atomic swaps and cross-collateralized coins and like pegged coins, if this reaches the scale we all hope it might, will it start to have an effect on the overnight markets of the traditional,
I mean, it could. Just looking at how it's being done at the moment, it would seem to like they would see it as quite separate markets, but it's also volumes, right? Like that we don't have the volume, like anywhere near the volume moving in cryptocurrencies as we do elsewhere. Now, if we find, some of those capabilities means that certain high net worth individuals or certain institutions find that this is a better way of moving it, then we could see a shift with that. But otherwise, this is a very separate economy. It's a very separate market that really at the moment, frankly, is running on speculation. But that's not necessarily a bad thing.
What I thought I heard you say about blockchain is solutions that could be migrated to blockchain have a lot of other capabilities that still need to be developed. And really the big story is currencies, new financial products. And my question is that a correct summary of what you said? And are there any exceptions where you think there are applications based on blockchain that may eventually be viable within financial services? Non-currency applications.
Yeah, sure. The thing with permissioned blockchains is you need a lot of parties you get a benefit from a lot of parties together who don't trust each other, and you can keep it simple enough that you don't need to monitor the system at all, right? If you have worked with any enterprise systems at any point, that third assumption is a very big assumption, right? The other two, so financial services, as I was mentioning, and this is very different from non-financial services, right? Non-financial services has a very different kind of trust structure, I suppose you could say. In financial services, like I was mentioning before, all of these banks work with each other. Now, are they going to trust them to, not steal their secrets or not get the best deal and hold back information that, they don't have to try to do that? Sure, but they trust them enough to integrate pretty closely with them on a number of their products, right? So when you're looking at those two aspects, this technology that is very hard to impossible to roll back, a real pain to change and upgrade, is really the best technology to do that with, right? Which is why sort of for us that, there are kind of big bets. Like if you look at sort of securitization networks, right? Housing, mortgage-backed securities, right? Really sort of a big sort of network of different parties having different roles, doing different things. You could create a network which traces all of those securities. The thing is, you've got to get everyone on board for that, right? So that's sort of what we're kind of calling a big bet. We're talking with all of these guys, we're helping with it, but there's a big lift for that. So you could see those things coming up. But, in the meantime, the infrastructure of public blockchains just keeps on kind of plodding along. And, and if you, I don't think it needs to be an either or. But if, you're looking at it, it's, the big lift stuff is, some people are probably going, some people are going to be successful with that and make a hell of a lot of money doing it. It's a heavier lift, right? And, so there's stuff that's sort of gone into production and going into production with that, but it's certainly not a quick win.
You mentioned that banks aren't actively trying to subvert how do you reconcile, or where do you feel the pressure is to lump cryptocurrencies in as a high-risk asset and force those kind of reserve expectations on banks that's coming up? And do you agree with that current classification that the U.S. government is trying to press?
So that won't be. So firstly, I don't think that that's the banks coming in and saying, "Hey, you got to put this into a high-risk asset," right? I think that is the. What that likely is looking at this and seeing an asset that we don't know who created it, fluctuates widely in value, and a lot of the on and off ramps seem to be regularly, hacked, and people lose a lot of money from it. Now, us being an industry know that each of those, you can address each of those risks. But from an outsider's point of view, it is, that can be sort of the starting point for kind of policy sort of discussions, right? Then at that point, that's when you will get, hopefully, lobbyists and education and all of this coming in and saying, well, actually, that's not actually fundamental to the asset. That's not actually, the fluctuations are, that's not actually a risk in itself. You look at oil, you look at gold, they've fluctuated at various times. If that, is the end state, I suppose I would be surprised. But there's, a lot of these things start off with, regulations coming in for, so the New York bit license, right? That came in and imposed regulations on New York. California was sort of looking at it, but a lot of that's kind of dried up, right? Because they start looking at the impact that has, and maybe that's not the best way to do it. So it's, we're all learning with this. I think even us on, I'm not sure but people that are, on the front line of all of this cryptocurrency development, we're, still working out what its potential is and all of that. So, policymakers are up a bunch of levels, and, it's kind of on the community to help them with that. Any other questions? All right. Well, thank you very much.